The market mood continues to improve as robust data from the US tempers recession worries and encourages price gains in the riskier pockets of the market. As such, while the European and US indices are preparing to close this week in a better shape than they were 2 weeks ago, but the same is not true for China, unfortunately. So welcome. This is Swissquote's Daily Market Talk. So the market mood got a further boost yesterday after the latest data release from the US hinted that, the US economy is not doing that bad after all, because the retail sales rose 1% in July. That was more than expected by analysts. The initial jobless claims rose less than expected last week, while New York Empire State and the Philadelphia Fed manufacturing indices were actually quite mixed and they did not attract much of the investors' attention. Walmart, on the other hand, gave support to these positive market vibes as the company did better than the estimates in the second quarter of this year and raised its full year revenue forecast on expectation that wealthier households will join the low income segment of the market in chasing good deals at its stores. Now I will come back to this later, but all in all, the combination of encouraging economic data and robust Walmart earnings gave hope to investors that the US economy won't collapse anytime soon. They actually revived the hope of investors of seeing the US economy soft land and ease the jumbo rate hike bets for the Federal Reserve's September monetary policy meeting, to which I never adhered, by the way. As such, the US 2-year yield rebounded past the 4% mark yesterday, and the US 10-year yield shortly rose to 3.95% level, but eased back to around 3.90% this morning. The S&P 500 jumped 1.61%, Nasdaq 100 rallied almost 2.5%. Yes, the index rallied almost 2.5% at yesterday's trading session, as did the Russell 2000 index, which also added nearly 2.5% yesterday on this reassurance that the US economy won't collapse anytime soon. So the US dollar index bounced higher yesterday from an almost year-to-date low level, and the US crude regained the 200-day moving average mark that stands near the $78 per barrel level and is consolidating near this level this morning at the time I'm talking here, with, however, little appetite due to the sluggish Chinese growth, mind you, because the oil refinery profits in China, they fell by over 90% in the first half of this year compared to the same time last year, which is huge. And even the tense geopolitical situation of the Middle East and this possibility of another escalation between Iran and Israel don't cheer up the oil investors enough right now to bet for a rise above the $80 per barrel psychological level sustainably. Now, that's good news for the inflation watchers, and it's not the only good news on the wire, because look, even though yesterday's retail sales data from the US came in strong, and obviously as another proof that the US consumers continue to spend despite the higher interest rates, the higher prices overall, and a high credit card debt, there are actually signs in the market that they don't spend at all costs. And this is what brings me back to Walmart, because if Walmart thinks today that its sales will grow more than they previously forecasted, it is basically because they think that the wealthier segments of the market are now also looking for deals to counter inflationary pressures. And Walmart said yesterday that they actually cut the prices of 7,200 products last quarter to maintain their competitive price gaps with the rivals. And other retailers like Target, Walgreens, Aldi, and IKEA, they also said to have done the same thing. Cut prices to bring the inflation squeeze customers back to their stores and eventually back to spending. And reportedly, the American car dealers also increased their discounts, to the highest levels in 3 years, and restaurant chains and restaurants are also unfolding meal deals like McDonald's, for example, to offer more affordable solutions to boost their customers' appetite in hope that once they're in the restaurants, they will want to spend on non-deal items as well. But all these news point that the widespread frustration with inflation is now putting downward pressure on prices and could eventually lead to more relaxed, looser monetary policies around the world. And if the easing happens without a severe economic slowdown, Mr. Powell and investors will eventually get the soft landing that they were dreaming of, and that could eventually keep the stock markets and the stock prices in a good shape. Although I think that the rotation from the technology stocks toward the non-technology sectors will likely tame the upside potential that we see in major US indices, as the past week's sell-off in the market came as a warning that the market is now oversaturated. The valuations of the big tech companies are high, and investors will naturally are pickier to jump in at historically high price levels without the promise of giant gains in the future. Even though I would like to note that the latest earnings season somehow ease worries for the big tech that their AI investments may not lead to the kind of huge profits that the companies and obviously also their investors were looking for. But all in all, the valuations are high and people know that. And speaking of the companies that big investors see sparkles lately, well, the latest 13F filings show that Warren Buffett's Berkshire Hathaway has lowered its stake in Apple, we all heard that, and added small stakes in retail cosmetics chain Ulta Beauty and also an aerospace company called HAECO, which actually saw their stock price jump 11% and 1% respectively on the news. Then Bill Ackman's Pershing Square Capital disclosed a new stake in Nike, and Big Short, the movies, Michael Burry actually increased his stake in the Chinese Alibaba. Yet Alibaba posted a meager 4% revenue gain and a 27% plunge in the second quarter profit, and its cloud business showed a meager 5.9% growth only compared to around 30% growth posted by the US peers for their cloud business as well. Alibaba shares were flat in New York yesterday and gained 4% in Hong Kong today. That was probably as the share buyback program from the company helped somehow countering the gloomy quarterly results, and its competitor JD.com actually jumped more than 8% today in Hong Kong after the company beat its earnings expectations, but sales there grew just 1.2% in the second quarter, the kind of numbers that you would expect to see from, from Germany, for example, and from, a small company and not from the Chinese e-commerce giants. 1.2% is almost nothing for a JD.com. And more broadly, for China, things are obviously not going well for the Chinese economy, as you may have noticed. The fiscal and monetary stimulus measures there couldn't really fuel growth. Investments actually grew slower than expected in the month of July. The production in China also disappointed last month, while the property crisis continues in full swing, unfortunately, because the prices of homes in China continue to fall. As such, not only the Chinese CSI 300 index doesn't really benefit from a rebound that we see in the developed market shares, but the country's biggest steel maker called Baowu Steel Group warned of the worst downturn since 2015. So no wonder the iron ore prices continue to melt these days, and Wisdom Tree's Industrial Metals ETF has given almost all of its gains that it made from May to July this year. A couple of futures, on the other hand, also see resistance near the 200-day moving average level. Looks like the reflation trade on metals is not appetizing when China is too sick to play. So this is all for this short week for me. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next Monday. And until then, good day trading and have a lovely weekend.